I think that you want to dial down the risk right now. And it's a perfect time because this is a massive market overreaction to what happened last weekend in Geneva. I'm not going to say that it wasn't good. It was just basically less bad. We're going to be entering new chapters of this trade conflict. It is foolhardy to believe that what happened over the weekend has meant the termination of this trade war. I think that's a serious mistake people are probably making right now.
Last week, the FOMC kept rates unchanged. In its statement, the Fed noted that uncertainty about economic outlook has increased further, and the risks of higher unemployment and higher inflation have risen. This comes as April's inflation data released today on the 13th of May showed consumer prices rising just 2.3% year over year, the lowest since February 2021. Some may view this as positive news, but uncertainty still remains with the Fed. So what is next? And we'll also be talking about what the 90-day suspension of tariffs between China and U.S. may mean for markets and economic growth. David Rosenberg joins us today. He is a renowned economist, founder and president of Rosenberg Associates, Research and Associates. Welcome back to the show, David. Good to see you.
Good to see you too, David. Thanks for inviting me back on.
Thanks for always being here and lending us your thoughts. Let's start by talking about the FOMC's decision last week and today's inflation report showing a 2.3% year-over-year growth. A little bit surprising despite tariffs taking effect. Were you surprised that inflation is still muted despite tariffs having been in place for a couple months?
Well, it certainly is an encouraging sign. And the consensus was 0.3 on both the headline and the core. We got a pair of 0.2s. And I was actually a little concerned that the number could be at least in line with consensus, if not higher, just based on the tone of the beige book that came out several weeks ago, taking note that a growing list of companies were starting to raise their prices in light of the early stages of this trade war. But as you said, plus 0.2 below consensus. I don't know if the number really matters, to tell you the truth, and you could see that in the bond market, which has basically ignored it. I do think that if it wasn't for this Trump tariff war, the Fed would probably be cutting rates right now, and you would have had at least a more constructive response by the Treasury market to today's data. But right now, the markets are being dominated by tape bombs and headlines and innuendos about any possible trade deal, agreement, framework, memorandum. And nobody really knows how these numbers, whether it's on the macro side or the inflation side, are going to play out in the next couple of months. So what was most interesting, in my opinion, was the really non-reaction, in fact, slight sell-off in the Treasury market to the data today, because you would have thought we would have rallied quite a bit. So the bond market itself is telling you that it's looking through the data right now. It's just basically all about headline news and nothing more than that.
There was some discrepancy between hard and soft data that were these discrepancies were highlighted at the last FOMC meeting, especially during the press conference when Powell was pressed by reporters about this. You've presented some soft data yourself. Take a look at this chart that you've been circulating in your emails. This is the Michigan Consumer Survey about their expectations for unemployment. Just a huge jump up. People are a little bit wary about the labor market. David, are you concerned about the labor market?
Well, I think the labor market is beginning to crack. It's not collapsing. And of course, everybody looks at the headline non-farm payroll report and the fact that the unemployment rate, which is a lagging indicator, is still rather low at 4.2%. But when you look through the surface, you could see a real change in complexion, a change in complexion that wasn't there in the last recession scare that we had back in 2022 and 2023. And what I'm talking about really is the internals, like how you would have a equity market specialist on this call and you'd say, well, beneath the headline, tell me about the market internals. The job market internals are weakening across a broad front. The hiring rate has plunged. It's below where it was during COVID. Companies are hiring fewer and fewer workers. The only reason why the headline employment numbers haven't been negative is because you haven't seen a firing cycle or a layoff cycle. But the layoff cycle typically follows a rapid decline in the hiring rate. Hires go down first, the fires follow down the road. The hiring rate is way down. The job opening rate way down. That's the classic signpost of labor demand. Job posting, job openings, they've fallen dramatically over the course, not just the past 6 months, but in the past 12 months. And the one thing that you like to look at in the labor market from a behavioral standpoint is what's called the voluntary quit rate. I call it the take this job and shove it index. And it's the degree to which workers are hopping from one job to another. When that number's going up, workers have tremendous confidence and enthusiasm and ebullience, and they have bargaining power. We saw that dramatically back in 2021, 2022, 2023. The quit rate has gone down precipitously. So we're starting to see a real softening beneath the veneer as it pertains to the labor market.
This is an interesting chart and somewhat scary. The composite index of 10 leading indicators from the Conference Board business cycle indicators, worse than pre-COVID. What's going on, David?
Well, it's been a bit of a frustrating indicator because it's been going down for quite some time. And actually, it was going down during that recession scare of 2022 and 2023. The recession, it was like waiting for Godot, and the recession never came. But
Yeah.
that leading indicator is still going south. It's down in the past 4 months. And it never behaves quite the same, nor does it have the same leading property cycle by cycle. I like to look at the year-over-year trend in the LEI. And remember, this is an indicator that's been around for the better part of the past 6 decades. And it is tried, tested, and true. It's just that the lags sometimes take quite a while to percolate through to the real economy. But the year-over-year trend right now has been running negative since the summer of 2022. Right now, it's negative 3.5%. And I only posit that if we manage to escape a recession, it'll be the first time that's ever happened with the leading indicator in negative territory year over year, as deep and as long as it has been. So we'll see what happens in the second half of the year. What got in the way of the LEI declining, which was precipitated back in 2022, 2023 by the most acute Fed tightening cycle since the Volcker years of the early 1980s, what got in the way of the recession call were two things. The excess pandemic savings. Remember the Joe Biden $2 trillion of stimulus checks mailed out to anybody who had a pulse. And I, for one, and I think most people never thought that all that $2 trillion, think about that number, would get spent. All of it got spent. It was the gift that kept on giving. It was the classic Energizer Bunny. All those excess savings have been depleted. But on top of that, we also had other forms of fiscal stimulus, the Biden CHIPS Act, the Inflation Reduction Act, which was a bit of an oxymoron, all these massive subsidies. They're not around anymore. We don't have the fiscal stimulus. Uh, I read Real Clear Politics every day, and I'm telling you, people think that there's going to be this big, bold, beautiful budget bill being passed in Congress. It's hitting a wall. There's not going to be any fiscal stimulus, and the Fed is still pinning the funds rate at 200 basis points above the rate of inflation. The real funds rate is plus 200 basis points. Where it was in 1980, in 1990, in 2001, in 2008, Fed policy is very tight. Uh, and the Fed is pinning the funds rate at 4.25 to 4.5, even as inflation is coming down. I guess the big question is, will it continue to come down? But you have a real Fed funds rate that's at the same level it was uh, preceding each of the past six recessions. Uh, so, when we talked about it, I was talking about it maybe a bit too much about this Volcker-esque type of Fed tightening cycle back in 2022 and 2023. But, it was less tight. When I look back as a Monday morning quarterback with perfect hindsight, the reality is that even as the Fed was raising rates, inflation kept on going up and up and up. So for most of the Fed tightening cycle in 2022 and 2023, David, most of that time, the real funds rate was negative. And it didn't climb out of negative territory until April 2023 when the tightening cycle was almost over. So that was the other, call it misnomer about the Fed tightening cycle. It probably wasn't tight enough when you look at the funds rate in real terms. But now it's just as tight as it was preceding the last six recessions. And there's no fiscal stimulus this time getting in the way. Um, so, with or without the trade war, uh, just the fact that the Fed is actually backdoor tightening by keeping the funds rate stable as inflation goes down, that the monetary tightening at a time of no fiscal stimulus, and you have a run rate on real GDP now, it's not 3 or 4% anymore, it's 2%. And then we can layer on all the trade and tariff uncertainty, which you could argue is dissipated over the weekend, but has not gone away. We have a very challenging economic backdrop ahead of us this year and into 2026.
Before we continue with the video, let me tell you about today's sponsor, Delete Me. Your personal information is probably online right now. Your full name, home address, phone number, sitting on data broker websites that anybody can access or buy. It's unsettling, but that's exactly why I use Delete Me. Delete Me helps remove your private information from hundreds of data broker websites. I've been using it for months, and every time I check my privacy report, I'm shocked by how many places had my data and relieved that it's gone now. Getting started is simple. Submit your info, and in about a week or so, you'll get a personal report showing where your data was found and what was removed. And it's not just one and done. Delete Me keeps scanning and removing your data throughout the year. Go to joindeleteme.com/davidlin and use promo code davidlin at checkout. Link down below or scan the QR code here on screen and get 20% off of all US plans today. Take your privacy back seriously before somebody else does. Okay, this is an important tweet that you made. The Fed gave a clear signal that wasn't noise today. This was a couple of months ago in March. So the 4.4% unemployment rate call for year end would take it 100 basis points above the cycle low back to 1948. That has never happened without an Enberg-defined recession. By the time the jobless rate rises this much, the recession has already been in play. Again, 2 months ago, anything's changed in your view since then?
Well, except for the fact that the unemployment rate is now at 4.2, not 4.4. But again, I like to go back into the history books because I don't believe in the refrain that it's different this time. I try to find true, tried, tested indicators that have never gotten the cycle wrong. And it's not the level of the unemployment rate that matters because I get that all the time. Well, look, it's only a 4.2% unemployment rate. Look, I can show you lots of recessions back to 1948 where the unemployment rate was 4.2% at the start of the recession. It's not the level, it's the change that matters. It's the change off the cycle low. So really, when I'm taking a look at the fact that we've gone from 3.4 to 4.2, and I think it's going to be going higher in the next several months because it tracks the hiring rate so closely. Yeah, I think that that is a very important barometer. Not the level of the unemployment rate, the year-over-year change. Ignore that at your peril. So basically, that still holds today, 100%.
Okay, let's talk about this reprieve, if you want to call it that, between China and the US. 90-day pause in tariffs, 115% reduction on both sides. Stock markets soared yesterday on this news. Is this the beginning of a rebound in economic growth, or at least for the markets?
Well, I really don't know how you could draw a conclusion that this is going to lead to a rebound in economic growth, because the 125% tariff that China had on and the 145% that the US had on was basically like a month. If you're going to tell me that for the past 10 years, we went from 145% tariff rate to 30, I'd say, well, hallelujah, because we probably will go from zero trade to massive trade. I don't know how anybody could say that the economy is going to be doing better. The 145%, let's say the 145% tariff rate that the US had on China, that's gone to 30%. How has that improved the economic outlook? It wasn't imposed that for that long. I think that we avoided potential Armageddon because it's a de facto embargo, and you would have had a $600 billion trade relationship go to zero. But David, it was there for a month. So how do you say that, well, boy, all of a sudden there's no recession, besides the fact that when you're taking a look at the fact that the US still has at least 10% baseline tariffs with everybody else in the world. And when you're taking a look at the de facto net effective tariff rate, the United States against the rest of the world, where is it right now after what happened on the weekend with China? Where is it? It's over 13%. So you say, oh, okay, good. It's not at 24% anymore. No, it's not. It's a 13. But where was it for years and years and years before the Trump tariff war? It was 2.5%. That's what the baseline de facto tariff rate was that everybody was operating under in this global trading relationship. So we've gone from 2.5%. And as things stand right now, and look, we have no idea with this mercurial president that can change his mind at a whim, which he does quite often. Right now, the only thing we know for certain is that the net effective tariff rate is over 13%. And that before all this started, it was 2.5%. So the way I see it, the effective tariff rate, the levy on global trade, has gone up 10 percentage points. It's gone up fivefold from where the long-term level was. That's a huge shock. Now, it's not as big a shock as it was, but we're comparing walking the plank to just going back to the ship in pretty stormy waters. So, no, I don't buy into that view that there's no recession coming out of this. This is a 10 percentage point shock on a $30 trillion beast called global trade. And people are going to tell me, oh, there's going to be no impact from that. The only impact would be if it stayed at 24%. No, this is actually still a very sizable negative shock. And when it plays through more forcefully in, as you mentioned, the hard economic data the second half of the year, it is going to hit hard. It is going to hit hard. If you're going to tell me, well, Donald Trump is going to do a complete reversal of everything, well, then we can talk turkey. But I don't see him doing that. He's on a partial walk back. It still represents a significant shock. It has not worked its way through the economy. We have to keep in mind something else about this illusion of growth we've been seeing, because everybody, knowing that or thinking that tariffs were coming, and not just with China, but globally, what were Americans doing the past several months? Pre-ordering, inventory buildup, and a lot of precautionary buying ahead of the tariffs, which gave this illusion of growth. That is going to create a huge vacuum in the economic data in the back half of the year. So I think that people involved in this risk on trade, and as you mentioned, that people think, I know we dodged a bullet. We didn't dodge a bullet. We dodged a cannonball. The bullet is still there. And when the bullet comes in the second half of the year, not a cannonball, but a bullet, nothing is priced for a bullet right now. People are going to be in for a very big surprise.
What does the surprise look like in your view?
Surprise looks like an outright recession. The recession that didn't come in 2022, 2023, the recession, which is about the boy who cried wolf, although the wolf shows up at the end of that story. The recession that nobody wants to call because once burned, twice shy. We got it wrong in 2022, 2023. We don't want to make that mistake again. So everybody is just, playing the cards close to their vest. I mean, here you have, I mean, come on. Goldman Sachs comes out and says that their recession odds have gone from 45% to 35%. How anybody comes up with those numbers, I think that's just basically a game of pin the tail on the donkey. 35% recession odds. Okay, whatever that means. But here's what it means. People say, well, it's not 100, it's not 90. 35% is actually pretty high.
Yeah. Well, the key is
And there's nothing,
upgraded.
well, there's no asset class priced for it.
Yeah.
Credit spreads aren't priced for it. The stock market certainly isn't priced for it. I'm not going to sit here and give you odds. I guess I would say, I like to say everything's a shade of gray. Nothing is black or white. Uh, Nothing is 0 or 100. So I guess I'll take it back. but I still don't know what 35% means. Do people feel good about 35%? I feel better if it's 10%. I think that recession risks, I'm not going to give you a number because
Yeah.
I think it's meaningless, but it is my base case scenario. I do not, and I would love to ask you, I would love to ask any of your viewers, they can all email me. You tell me where you see the vitality in the US economy at this point. There is no fiscal stimulus coming. There is no tax cuts coming. If you read what's happening in Congress right now and the 30 Freedom Caucus members who are adamant about any increase in the deficit, these tax cuts aren't coming. But what is coming is spending restraint. As Donald Trump would say, spending restraint of the likes we haven't seen before. That is actually here and it's going to continue. The rest of the world economy is flat on its back. So there's no multiplier impact from the export sector. Housing is being massively constrained by elevated mortgage rates and the fact that home prices are still well above, you can call quotes their intrinsic value. Affordability is a two standard deviation event. No first time buyer can really afford to buy a home. It's why housing is in the doldrums. And the consumer just went on a spree to buy stuff to get ahead of the tariffs. So what do you do for an encore? You're not going to buy all that toilet paper and that clothing and all that building materials.
Yes. Well, okay. So here,
And so so
yeah.
so yeah, so the economy is going to be extremely weak. It's not going to be strong enough to justify the earnings embedded in the stock market. The Fed will scramble to cut interest rates just like it did in 2019. The Fed right now, look, it's like you asked about the Fed. Jay Powell tells us in December, here's monetary policy for the here and now. And he compares it, this is the Q&A session after the meeting. He says, what does a central banker do in this period of high and rising uncertainty? It's akin to being in a dark room with furniture. So what do? You stand still. So no surprise out of the Fed. They're just standing still until they get some degree of policy clarity and they see what inflation does, not in the month of April, but probably for the next several months.
Mhm.
And whether this is a temporary shock, of course, they got transitory wrong. They're not going to make that same mistake twice, especially because Jay Powell's tenure as head of the Fed ends in May of next year. So he's not going to go out as the next Arthur Burns. So they'll be slow to cut rates. But if you remember, under similar but not the same conditions in 2019, because the situation is much more fluid today than it was back then. But the Fed went into 2019 in their dot plot saying we're going to hike rates twice in 2019. That's what they're telling the market. And of course, if you go to the FOMC policy minutes and you go to the transcripts, you get a real flavor for all the concern about tariffs and trade and inflation. They're going to raise rates twice. What do they end up doing in the second half of the year before COVID? They cut rates three times. The bond market was a great place to be, but you had to be patient. And I think we're going to replay something very similar this time around.
This is a curious thing that just happened. By the way, the Atlanta Fed Q1 estimate was negative. I think they got that right. Anyway, they switched their Q2 estimate now to positive territory, 2.3%. Now, a lot of the negative GDP from Q1 was because of imports, and net exports were negative, as you know. So I wonder how much of that was just pulled forward. You know, people importing a lot that made the recession, that made the GDP data negative, but other areas of the economy were fine. Do you agree with that assessment and whether or not Q2 is going to be positive?
No, I don't agree with it at all.
Okay.
The reason why the number was so surprising was you had a 20% annualized increase in business capital spending,
Mhm.
which did not line up with the monthly indicators at all. At all. That added a full percentage point to GDP growth. That came out of nowhere. The consumer spending numbers, as good as they were below expected. Housing remained in the doldrums. Commercial construction, there's nothing going on there. Um, and the government sector, which has been a huge source of support for the economy, is now moving the other direction. So, yeah, you had a lot of trade distortion, a lot of tariff distortion in that number. Uh, but when you're looking at the components that made sense, if you're taking a look at the incoming monthly data, it was consistent with a contractionary economy. You talked about the soft data and the hard data. Well, here's the reality. Everybody bows to the holy grail of the hard data, but the hard data gets revised. I mean, look at the revisions. We just got to non-farm payrolls. They were huge. Non-farm payroll seems to get revised three-quarters of the time downward every month. Hard data gets revised because the government is releasing the hard data. The government tries to release the hard data in a timely fashion, which means they give us incomplete information. It's not that they're stupid. It's not that they're slow. It's just that the data we get, whether it's retail sales or whether it's employment, whether it's durable goods shipments and orders, this is all government data from the Commerce Department, and these numbers get revised substantially.
Yeah.
Why do you think, when did they date the recession? When did the NBER come out and tell us about the recession in 07, 08? They told us in December of 2008 that we had a recession. And the recession started in December of 07, 12 months earlier. Why? We were in a recession 12 months, and the NBR tells us in December the recession was almost over at that point. It ended in June of 09. Most people didn't even know in the summer until basically Lehman collapsed that we had a recession. We were in recession 12 months, and the NBR tells us 12 months in a recession that we're in a recession. And of course, it sounds like a bit of a joke, but it's not a joke. They're just waiting for all the revisions. They know the data are going to get revised. People were actually shocked that it started in December of 07, because even Bear Stearns didn't collapse for 3 months after the recession started. You see, people think that the financial calamities caused the recession. No, actually, the recession, part of the business cycle, ends up impairing cash flows and the quality of balance sheets, and that's what triggers the financial instability. The causation runs the other way. So everybody's talking about the hard data, waiting for the hard data. The reality is that the soft data, which is the survey data you're talking about, that doesn't get revised. That doesn't come from the government.
Yeah.
And it's all behavioral. It's all behavioral. You showed me before about the University of Michigan index. It shows you 12-month expectations. You showed that chart before. When you go to the non-farm payrolls is a robot. Okay, it spits out a number, and then millions of traders trade around the number, but it tells you nothing about the shifts in the pattern of behavior. But you flash the University of Michigan survey, which shows you that at the margin, households are becoming very nervous about their job. 1 in 7 Americans now are fearing a job loss. You got the share, that half of the American public don't believe they're going to get any wage increase at all in the coming year. Half. And the median increase is the grand total of 0.4%. So I actually find it very interesting that the Fed is so consumed with inflation fear from the tariffs, and yet Jay Powell says each and every meeting there's no inflation coming out of the labor market. Well, you can't have it both ways, because if there is no inflation coming out of the labor market, there's no inflation coming out of anywhere.
Mhm.
And that's where people got it wrong, including me, by the way, in 2022 and 2023, that we did get inflation out of the labor market, right? We did have people job hopping. There was a tremendous demand supply mismatch in the labor market coming out of COVID, all the stimulus checks. The fact on top of the stimulus checks, people were getting paid unemployment insurance that paid them more not to work than to work. So companies had to increase their wages dramatically. So we had a wage price spiral for 18 months in 2022, 2023. This time around, there ain't going to be no spiral. The inflation is going to hit the wall in the labor market. And you see, that's the beauty of the so-called soft data.
Mhm.
I talk about this with my clients. They say, "Yeah, but it's soft. It's soft data." Well, that's a label that Jay Powell gave it. We're going to wait. We're going to wait for the soft data to land on the hard data that only gets revised. We're going to wait for the soft data. And the soft data is not dollar signs. The soft data is purely behavioral.
Mhm.
It's about employment. It is about how people feel about employment opportunities. Are they seeing more or fewer jobs? What are companies doing? The soft data tells you whether or not companies intend to raise or freeze capital spending. That doesn't come out of the hard data. And the reality of the situation is this in terms of causation, the soft data leads the hard data. The hard data doesn't lead the soft data. So we're all saying we're going to wait, and the Fed's saying we're going to wait for the soft data to hit the hard data. Well, I'm going to tell you something. By the time it hits the hard data, it's too late. The recession has started, and the Fed will be scrambling hard to cut rates. And the Treasury market will be rallying significantly. And that's going to be the story, in my opinion, in the second half of the year, which is starting in about 6 weeks' time.
Okay, so let's finish off then on investment implications. Good segue. I have here the 10-year yield chart. You're saying that there's going to be a rally in the Treasury market. So what are we going to see the 10-year go down to, you think?
Look, David, if when you're taking a look and stripping out the components of what's driven yields higher, it's not been inflation expectations.
Mhm.
I'd be a lot more nervous if it was. And it's certainly not about concerns about accelerating economic activity. It's all been in the term premium. It's all been in the heightened level of uncertainty, policy uncertainty, trade uncertainty, fiscal uncertainty has all been embedded out to the 10 and 30-year bond. If it wasn't for the ratcheting up of the term premium, the risk factor, the risk factor in bonds that cannot be explained by inflation, by the economy, by the Fed, it is the unexplainable part of the nominal treasury yield, which is now bordering on 4.5%. If that went back down to where it was 3 months ago, the 10-year note would be 3.75%. So I think 3.75% is a gimme. I think we're going to blow below that in the next 12 months. I wouldn't be surprised if we get into, call it a 3 to 3.5% range between now and this point next year. And I think that you're going to find that the much maligned, ignored, despised Treasury market is going to be the one market that is going to be delivering equity-like returns over the next 12 months.
The term premium that you spoke about. Okay, so let's take a look what's happened into the bond market so far. The DXY has been tracking the 10-year yield. Some of this may have been due to tariffs. Some of this may have been due to the perception of the strength of the dollar relative to other countries because of the trade war. Do you agree that now that we have this resolution, this 90-day resolution, and in fact, Trump is making negotiations with other countries that we're going to see continued bullishness in the yield, meaning the 10-year is going to move upwards, the dollar is going to get pushed upwards. That is a counter narrative. How would you address that?
I just finished saying that I think the next big move in Treasury yields are going to be lower,
Okay.
not higher. And if you're basing your decisions on a 90-day reprieve, well, remember the first reprieve with everybody else is going to be July the 7th. Well, let's see what happens. You're going to be basing, I mean, look, here's what I refuse to do. I refuse to follow the Pied Piper, okay?
Mhm.
I refuse to basically get lulled into a market that's being driven by headlines and momentum and noise. You're just talking to me about noise right now. A 90-day reprieve, and what happens next? I don't know. I just finished telling you that if you believe Trump is going to walk back everything, I mean, if you believe that, you have to believe that he is going to change religions, okay? He said, he said that the word tariff is his favorite word of the dictionary. He is going to be moving aggressively to ensure that these trade surpluses that other countries run against the US are going to come down. So the reprieve might bring, so, whatever the reprieve brings, do we know anything about these deals? They're called deals. They're not deals. They're frameworks. They're memorandum of understandings. Who knows what's even in them? Uh, it's it's really hard to make book. Uh, I think that anybody that's making their decisions based on the reprieve, I mean, you can trade around this. If you're a trader, as Sarlozzo told Vito Corleone in Godfather 1, to salut. But how do you invest in this environment? Are you going to say, okay, 90-day reprieve? You're a real long-term investor. Is that going to impress you? You're a Warren Buffett. Is that going to impress you? The 90-day reprieve in the overall scheme of things. You're in the business sector and you have to plan CapEx, which has a gestation period longer than 3 months. Is 90 days companies with the reprieve, David, in your opinion? I'll throw the question back at you. Do you think companies are going to say, oh, we have the reprieve, the CapEx that we decided to freeze a few weeks ago, we're going to bring back on? I'm going to tell you something. That's not going to happen. Okay, so we are still into an elongated period of elevated policy and economic uncertainty. The analogy back to Jay Powell of being in the dark room with furniture, that hasn't changed. And when you bring this to a real world perspective, what it means is that businesses, with or without the reprieve or with or without the volatility in the stock market runs in both directions. You and I would be having a totally different conversation, right? 4 weeks ago. Would you be making any bets? Would you bet your family's money on what our conversation will be 4 weeks from now? I mean, who knows? This is policy on the fly. It's totally chaotic. But what I know, when we model out uncertainty, and the first economist to actually model uncertainty was John Maynard Keynes. You can model out uncertainty. And what it means in the business sector is you focus on liquidity and you focus on balance sheet strength at the expense of capital expenditure. In the household sector, which is 70% of GDP, what does high levels of uncertainty mean? It means you build up precautionary savings rates at the expense of discretionary expenditure. So you're going to ask me, based on what happened on the weekend when we dodged a cannonball but faced a bullet.
Mhm.
Well, I got news for you, David. A bullet can still kill you. So no, my overall views haven't changed one iota.
A bullet can still.
And let me just add, by
Sure.
the way, the Fed will be scrambling to cut interest rates in the second half of the year, when most other central banks will have already been done. And now you're having the big fiscal bazooka out of Europe, led by Germany, at a time when we're going to be seeing fiscal restraint in the United States. All roads lead to a stronger euro. And on top of that, there's nothing more stupid cheap on the planet than the Japanese yen. And the BOJ is like the deer in the headlights. Their real rates are negative. They don't have a massive inflation problem, but their interest rate structure is inconsistent with where their economy and their inflation numbers are. So they will be tightening policy and the yen will be rallying. Well, there you have the DXY right there. I think we're going down to new cycle lows in the US dollar between now and the end of the year. And I think that Treasury yields will be following suit for very similar reasons.
Bullets can kill you, but what is our Kevlar as investors? How do we prepare ourselves defensively for this coming recession? I'll leave it here.
Well, look, Kaz, look, I'll tell you right now, the equity market, what's happening in the equity market right now is we went in a month ago, the Bank of Montreal global fund manager survey showed that world portfolio managers had a 38% net underweight exposure to the US stock market. And now they have to participate or they'll lose their clients. So you're seeing that gap close. It's really a classic short squeeze that's taking place, but also real-time investors have to get to their bogeys or their benchmarks. So there's a very strong fund flow impact that's going on right now. It's fun to trade, but I don't think it's going to be sustainable. You have what? You have a 4.8% earnings yield in the S&P 500. 4.8. You got 4.4%, 4.5% on the 10-year note. You got 4.4% in cash, in T-bills. So I'd say if you're chasing the stock market right now, do so for a trade. But from an investment standpoint, it is not what I would refer to as prudent risk management. So I would say take down your cyclicality of your overall asset mix, take down the beta, de-risk. I would say, if you didn't get out the first time, from February to April, uh, and you were there with your white knuckles, oh my God, the market down almost 20%. Now we reverse that. This is a gift from the gods to actually cleanse your portfolio and de-risk it. You're getting a second opportunity. But you see, what most people are going to do, because greed is such a powerful emotion. I've been doing this 40 years. Gordon Gekko, greed is good. And instead of doing the right thing, which is to use this as an opportunity to de-risk, I bet that most people on this call are going to do the exact opposite because chasing rallies tend to be a lot of fun, I guess. Not prudent risk management. So I would have cash, I would have treasuries, I would have gold, I would have the gold miners. Within the equity market, there's parts of the equity market I like a lot. I like what I call bonds and drag in the stock market. Stable industries that have solid dividend payout ratios and a decent yield. Do I like utilities? Yes, I do. Do I like the financials? Some of them I actually do. Do I like telecom providers? Some of them I do. What I would do in my equity portfolio is make sure that it's low beta, so that you will capture any upside, but you won't capture much of the downside if things roll over. So I'd focus on the beta of the portfolio, and I would focus on the running yield of the equity portfolio. On top of that, I would say that go to the areas of the world that have some visibility.
Mhm.
And Europe actually has fiscal visibility. I think that their economy, believe it or not, is going to outperform the US economy. I think it's going to be a better currency. And I like especially the aerospace defense industry because that's where the money is going to be flowing. And I would say my favorite currency, it might be tied right now, but it's the euro and the yen. And I think if you have euro and the yen, you have aerospace defense, which obviously, for a whole host of reasons, has earnings visibility for now and the future, bonds, cash, and the more defensive bond proxies in the stock market. I think you'll be good to go.
You know what it is? I'll end it here. Psychologically speaking, I think they've done studies on this. People feel worse missing rallies because of FOMO than they actually do miss losing money. Some people, at least. So
I,
I think that goes
well,
back.
one thing I missed, by the way, was the gold and the mining stocks, but you're
Yeah.
100% right. You're 100% right. I could tell you in my years at Gluskin Chef, it was actually, I learned so much, 12 years on the buy side. And I heard that from many clients. Just the anger and anxiety and angst. You can see their blood boiling when, even if they were up 20%, if they were out washing their car and their neighbor passed by and said he was up 30%, ooh, the anger and the angst was incredible. So I've had people tell me that too. People have told me I would rather lose money in real time
You know,
than underperform my neighbor. And I'm there thinking, okay, that's not my philosophy, but thanks for sharing that with me.
greed is
I
good, and
I just telling you, if you ever interview any NHL coach, any NBA coach, any baseball coach, they'll always say, I hate losing. I hate losing. I hate losing. And I'm going to tell you something. I hate losing money, which is why, by the way, and I guess this is one of the beauties about being a quotes perma bear, which is actually not true. I'm just conservative, cautious.
yeah.
And my philosophy over time, and maybe this is just for a certain demographic, is I believe in the preservation of capital and the preservation of cash flows at all times. Full stop.
Maybe later this year we'll have you back, and you'll be a little more bullish. We'll see. I don't know.
Well, I'm bullish. I'm bullish on bonds and I'm bullish
Yeah.
on gold and I'm bullish on bond proxies. I'm just not bullish on anything that touches the cyclical part of the economy. Sorry about that. I know that might offend some people but I'll tell you, I think that you want to dial down the risk right now. And it's a perfect time because this is a massive market overreaction to what happened last weekend in Geneva. I'm not going to say that it wasn't good. It was just basically less bad. But the markets are pricing in something that I think is not so Nirvana-ish because I don't sense that.
Yeah.
I think we're going to be entering new chapters of this trade conflict. It is foolhardy to believe that what happened over the weekend has meant the termination of this trade war. I think that's a serious mistake people are probably making right now.
Okay. Let's end it here. Good thoughts. Greed is good, and so is Rosenberg research. So where can we follow your work?
So you can just Google Rosenberg Research, and it'll take you right to the website. We have a free trial for those that want to kick our tires, by the way. Uh, you can just also information at rosenbergresearch.com. And although I won't give out my phone number, I will tell you if you want to email me directly, feel free to do that. It's drosenberg at rosenbergresearch.com. And I'd love to interact with you.
Okay, we'll put the links down below. So make sure to follow Rosenberg Research and David there. Appreciate it, David. As always, thank you for your time. Speak soon.
You too. Take care.
Thank you for watching. Don't forget to like and subscribe.